Hey guys, I'm Big Mike, and like always, I'd like to thank you for being here today. Today we have a webinar with John Hoagland from TopstepTrader. The webinar is titled Rookie Mistakes When Trading Profile. And John is going to be talking about both market and volume profile today. The webinar is aimed at beginners or rookies that are new to trading profile. And John is going to highlight some of the most common mistakes and certain things that you can do to try to avoid those mistakes. The webinar is being recorded like always. If you're watching the recording on YouTube at a later date and you like it, please do us a favor and give it a thumbs up. John has said that he will take questions as they come. So if you have a question that is relevant to whatever he's talking about at that moment, go ahead and type it in and I will ask the question to John. All right, guys, give me 1 second, and I will turn things over to John. All right, man, it's all yours.
Thank you very much, Mike, for hosting this webinar. And everything look okay?
I have audio, but I don't have video yet.
All right. Hang on 1 second. I apologize.
No problem. No problem.
Now we should be cooking.
Yep. Now we got it. All right. Thanks, John.
Thank you. Big Mike, thank you for hosting this webinar and your fine trading forum as always. I'd like to thank the attendees today for trusting me with your time, and I'm hoping that you're going to find some value and something you can bring forward out of today's webinar. I'll tell you a little bit about, hang on a second here. Tell you a little bit about myself. I've been in the industry 31 years now. Currently the Director of Trader Development at TopstepTrader. My dad was in the industry long before I was, as was his father in the cash grain industry out in Nebraska and Iowa. But I started the way most people do in the industry. I started as a runner and worked my way up through the ranks, became a self-funded trader and a floor broker over my tenure at the Mercantile Exchange. I did focus on agricultural products originally, but now mostly equity indices and crude oil and gold now has crept into my life a little bit. But yes, my primary analysis for trading is market profile and volume profile, reading volume and order flow. It's something that was actually introduced to me by my father when I was in junior high school. He had a friend on the floor named Pete Stottlemyre who was developing a new way to look at markets and asked me if I was interested in it. Of course, at that time, no, but eventually it came back into my life and has been probably the single most important thing that I've been able to develop a sense for. And now I am working with our funded traders at TopstepTrader and conducting a daily market profile strategy lab, helping other traders develop their intuition around market profile, volume profile, and the features within. It is something that I enjoy greatly, and it's really taught me a lot about what people need to know before they get involved with market profile and help them avoid some of the mistakes that a lot of people make. TopstepTrader, if you don't know, is a company we're really trying to help change the way people approach the financial markets. There are too many people out there going at the markets without the proper ideas and education and experience, and we feel as though we've developed a format that, without risking your own trading capital, allows anyone interested in the market, futures markets right now, soon to be in Forex, gain market experience, training, and all in a real-time simulated account, and also the opportunity for funding along with that. So very proud to be with TopstepTrader and having a lot of fun with it. As well, learning a lot myself, the usual U.S. government required disclaimer. We all know that futures and options trading has large potential rewards, but also huge risks. You got to be aware of these risks and be willing to accept them in order to invest in futures and options market. Don't trade with money you can't afford to lose. Today's webinar is, of course, neither a solicitation nor an offer to buy or sell future stocks, options, or anything. No representation is being made that any account it will or is likely to achieve profits or losses similar to those discussed anywhere. Past performance, of course, is not indicative of future results. So to get that business out of the way, let's get down to business. We're going to be talking about market profile and volume profile. You can see the graphic right there. And really, in order to begin to understand and develop an intuition with this tool, volume profile or TPO profile, I think that they're very closely related and important to each other. You've always got to remember what a market is. It's a two-sided auction, and the auction never ends. This auction has an infinite number of combinations of information, opinion, motivation, emotion, aptitude, fortitude, egos, desires, etc. Time frames. There's an infinite list of things that affect the market and the people that are involved with in trading these markets. The auction process takes all this information and discovers the collective perception of value of that asset at that time or at a certain point in the future. As prices auction higher, the advertised price may become too high, cutting off buying activity and at the same time enticing sellers who are viewing the price as too high. This would obviously mark the end of an auction higher and the beginning of an auction lower, which will continue until the opposite occurs. Advertised price at lower levels cut off selling and perhaps entice buyers. The auction lower ends and price would then begin to auction higher again. You can see in this example here, I think you can see my pointer.
Yes, we can.
Here, we'll do a spotlight. You can see in that example, in this profile, how the market opens here, auctions lower, perhaps volume runs dry. You can see the lack of volume here. Buyers are enticed to move this market the other direction. Price gets a little too expensive. The market then, that auction then ends, starts to return lower. The market basically rotating between these levels until later on in the day, perhaps buyers become more interested in this market or sellers back off and the market ends up near its highs. So the auction process is very simple. It is every free market functions pretty much the same way, and the market and volume profile work in similar ways to create a picture of the auction process that can, with time and practice, limit one's risk and increase the probability of finding good trade opportunities. By good trade opportunities, I mean low risk and high reward. That's our number one job as futures traders should be to limit risk. Only take those trades that offer low risk and high rewards. I can't stress enough how much I think that volume profile and market profile depend on each other to give this tool its ability. So when you take a look at the auction process, you're really looking at price, time, and volume. Price is the advertiser. Okay, if price gets too expensive in the eyes of most traders, buyers will back off, sellers will come in thinking they're selling it high. What's our job? Sell it high, buy it low, right? Time is the regulator. The best trades, you're not going to have a lot of time to respond. Okay, when this auction lower ended down here, the market spent very little time, and volume, the validator, didn't show up. The market did not attract activity and volume at this level. Recognizing that and responding quickly gives you great trade location on this particular trading day, because you caught the end of the auction lower, you responded quickly, and price then indeed did auction higher largely through the rest of the day. When you take a look at this, it really seems like it should be easy. Okay, it looks like it's getting too cheap. We'll just buy it. When it gets too expensive, we'll just sell it. As price approaches high, and maybe you do take a sale at what you perceive to be too expensive, and an event occurs, or certain players decide that they need to enter the market or adjust their inventories at that level, and all of a sudden what was originally seen as too expensive is now cheap. The market drives away from the previous balance and is now, instead of in balance, which this is a relatively balanced profile in TPO and in volume profile, the market drives away, drives higher, and now you've got shorts in the market that are now taking heat. They're going to have to respond. This is the way markets move and attract more activity. Increasing volume in a particular direction means that the market is more likely to continue in that direction. The auction higher will continue until two-sided trade can ensue. A new area of balance is established, and the market returns to a balanced state. This is a lot to take in if you are very new at profile. These are pretty basic features or pretty basic activities of the market, and it takes time to learn how to use the profile. We're going to try and help you avoid a few mistakes.
And John, I don't know. I don't know if you've got this coming up, so hopefully I'm not stepping on your toes, but just so everybody understands. So on the left, that's the market profile, also known as TPO, or time price opportunity, and each letter represents a 30-minute period of time, okay, with A being the open, right? And then to the left of that, the kind of yellow color vertical line, that's the initial balance, right? And
opening range.
Or opening range, okay. Everybody does it differently, right? And then to the left of that is the value area, right?
Right.
And then on the right side is the volume histogram, which doesn't incorporate time. It only looks at price and volume.
Right, yes. So we'll take I'll go through that again, and I have a couple of examples of the profile split so you can see how the details and the information in the profile is actually very similar to a 30-minute chart. This particular profile and the way profile was originally designed was based on 30-minute periods. So what Mike is saying here, this gold bar right here, I have signified as the opening range. It's the range for the first minute of the trading day. And in case you're wondering, this is only the day session. This is an S&P profile. I don't have any price on it or anything, but it really doesn't it doesn't matter the market. The profile, it works the same way in whatever market that you're looking at. Yeah, so this would be the opening range. This is the first minute. I've always felt as though that the opening range is a very important time of the day when there are going to be larger traders who may be in control of the market for a better part of the day or an entire day. Usually this opening range will be at the extreme. It'll be at the very end, one end or the other of the profile. The blue line here is the initial balance. This is the range for the first hour of the day. Now, the original idea of the initial balance, from the way I understand it, is the first hour is usually, unless there is some larger trader control, the local traders or the smaller speculators searching for the area where they're going to be able to somewhat depend on two-sided trade, a range that they're going to be able to trade in order to take small profits. many times during the day. Your scalpers or your very short time frame traders, depending on the initial balance. So the construction of the profile is, you can see the A period here is the entire range for the first 30 minutes of the day. The B period here is the entire range for the second 30 minutes of the day. The C period, the third 30 minutes of the day, and all of these are pushed to the y-axis. Everything is pushed to the left-hand side so that you can see the profile graphic or the bell curve beginning to appear. So I have another graphic that I'm going to show you shortly that will separate all these different time bracket TPOs, and so you'll be able to see how really similar the information is when you straighten it all out and make it appear like a 30-minute chart. Over on the right here is this is the value area, the green line. And to the right of that, the blue line here is the volume value area on this profile graphic. This is the T4 profile program. Okay, and then this is your volume histogram. Has nothing to do with time, but shows you at each price how much volume comparatively has traded at each price. Now, if you have the T4 screen up, there's a lot of information that you can pull up. You can see what the volume, what the delta, what all the different features as far as the way the market has traded in each of these TPOs at each price. You can see how much volume traded at each price. Just for simplicity's sake, I've left those off this particular graphic. So there are a lot of features. There's a lot to know when it comes to volume and market profile. I really, in my years of learning it, because I think it's a constant learning process, and now hopefully being able to help others learn the profile, there are some mistakes and some misconceptions that I thought would be good to talk about today. When you are learning profile, it is, I believe, very important anytime you're looking at a new tool to test it in simulation. You know, if you're new to the tool, it's like changing your golf grip. At first, things are going to feel a little strange, and your golf game may suffer a little bit. But if you're doing things right in the long run, your swing and your golf game will improve. And that's really kind of the way I feel about getting a grip on market profile. One of the first things that I noticed when I started using profile, both volume and TPO profile, was the choices I was making for the locations of the trade that I was making improved greatly. I was really finding it much easier to stay out of trades and in areas where the probabilities weren't as good. And over time, by journaling my experiences and my emotions while trading and while using profile, the picture really at times becomes very, very crystal clear. You become a lot more confident, and your intuition with these tools becomes distinguishable from impulse. And think about that. To be able to distinguish impulse from true intuitions is a huge step. The road to becoming competent with profile, it does take a while. Like I said, you'll always be learning, even as your competence grows. The rewards of being, successful with this can be limited. It's totally up to you, and that's the other half of the equation. You've got to have market knowledge. You've got to understand how markets move, and the profile will help you do that. But you also have to have the self-knowledge. You have to understand what makes you tick, what your strong points are, and emphasize those. What your weak points are, what your weaknesses are, and work to nullify or minimize those along the way. With anything as full as information and nuances as the profiles, there are many mistakes to be made along the way. That's why you've got to work with it, got to test it in simulation before entering into a real market situation doing this. And I see mistakes most often with traders learning and trading with market profile and volume profile, and pretty much in these orders. The first thing that I usually hear is, hang on one second.
If you hit escape, you trying to flip the chart?
Yeah.
Hit escape to change the cursor, and then you can do it. Okay. You were still on highlighter.
Right. Okay. Everybody seems to think that that the profile is a signal generator, that it's going to provide if-then situations for you, and it's simply not the case. The profile is an intuitive tool. The profiles really are going to help you identify when the market is in balance or in imbalance, and when change is occurring, and those opportunities when change is occurring or not occurring in real time. Looking at any time frame chart, you're looking at information that has already happened, and there are ways in the profile to be able to distinguish what is going on in real time in the market, who is involved, and how you can take advantage of it. So that's the best thing about it, is they point out the key areas to consider a trade, but not necessarily direction. This is where your volume is going to come into play. I'm sure you remember we were talking about the price being the advertiser, time being the regulator, volume the validator. If a market is moving in a particular direction and volume is increasing, activity is increasing, interest in the market in that direction is increasing, it's more likely to continue in that direction. If volume and activity fall off in a particular direction, it's likely that a change is near. And this happens in all time frames, in short time frame trades, in daily trades, in weekly and monthly. That happens in every time frame. So again, the profile, an intuitive tool that will tip the hand of larger players and provide possible directional information. And as we go through here, I think we're going to take a look at a couple of examples from today that the profiles really gave us the idea that a market was that a change was happening in a market, and that we were going to have to be ready to take advantage of it, and that change today was in crude oil. So again, volume and participation at key levels is really what you're going to be looking for. You're going to first find those key levels using the profile, and then you're going to, through your knowledge, your intuition, your ability to read tape and read activity, and journal about it, because if you're not journaling about it, you're really slowing your learning curve. I'm going to take a second here and bring the crude profile from the day session today into the picture. A little too tall. Okay, it's not all going to fit in here, but we'll get the right ideas. Does that look? Can you guys see that all right?
Yeah, it seems fine.
Okay, all right. Thank you, Big Mike. This is also a good one for point 3, but what we're going to take a look at here is, if you remember, we were talking about the initial balance. Okay, this blue line here is the initial balance from crude oil. Initially, the market opened here, and within the first hour or two seemed like it was ready to pretty much just balance between these 2 points. Okay, we had a little bit of a failed auction down here at the low. Then the market rotated all the way back up, and then traded through the high of the initial balance in D period and put up a high up here. Okay, and then it returned to the initial balance and basically went back to the two-sided trade, to the balance that we were talking about earlier. One of the features of the profile that tipped this move off in crude to me is called the point of control. Now there's two different points of control here in the profile graphic, the TPO profile graphic and the volume profile graphic. Through the better part of the day, the point of control is in TPO the widest point, the widest level of the profile closest to the center of the range. So you can see before the second run up here, the center of the range was probably somewhere in this area. Okay, we had a lot of range trade and point of control, I think it was right around in this 61, 62 area. It's about the center of the range. Okay. Late in the day, when this market really kind of refused to break, the volume profile was also lower for a better part of the day also. Now, this red line right here, this is our TPO profile. It ended up being our end of day point of control because of the range extension. This is our volume profile point of control. The volume profile point of control is the price that traded the most volume for the day, which also moved up throughout the day today. When you see point of control moving up in a profile graphic, it indicates the possible presence of longer time frame, larger buyers in the market. And I think what happened today is I think a lot of short time frame traders were viewing this D period selling tail, which is yet another feature of profile, as a negative and a rejection. Okay, that the market did not spend time here, did not draw a lot of volume at this level, and rotated all the way back. I think a lot of short time frame traders got stuck short against bigger buyers that late in the day turned up the heat and forced the hand of all these short time frame shorts into covering shorts. Now this, I think, got a little bit more than short time frame shorts involved. I think there were multiple time frames involved in that rally at the end of the day in crude oil. And I'll be honest with you, I was looking for more to the downside today as well. I got caught fishing for short down here. I got caught short here, but by the time this market traded back up into these D period TPOs, I was long and ended up having a good day from a bad day. So that is one of the features that can tip the hand of your other time frame or your larger players and at least keep you out of trouble, if not get you on the right side for larger moves like that. This is a lot of information, and Big Mike, if you have suggestions of things to let people know that, yes.
Okay, sure. Ahead. There's a couple of questions before we go to the next one.
Sure. Let's go.
Let's see. Yai is asking, what is the general rule for determining the opening range?
Okay, I use what in pit trade there was no general rule. There was no time limit and there was no price range limit. The opening range was however long it took and whatever price range it took for all the orders that were in the pit before the opening bell that were due fills on the opening bell. Sometimes opening ranges were 1 or 2 ticks and 10 seconds long. If there was a lot of business to conduct, opening ranges got bigger as far as price range and took longer. In electronic trade, I kind of feel as though a minute is plenty of time for the opening range because anything that's due a fill is being filled, quite quickly, a lot faster than humans can do it. And Some people like a longer opening range. Some people would prefer a shorter opening range. T4 doesn't let you go any shorter than a minute, but it's what I think I would prefer because I think it gives plenty of time for the orders that are due before the open, which it's already open, to be filled, and I think it gives enough time for larger players that may have orders that they need to get filled right away in the day session to enter the market.
Okay. Fred has a question. He says, can you talk more about the difference between impulsive decisions and intuition, which he believes you said market profile allowed you to know?
Yes, it's a process. It's taking the trades, it's working with it on the simulator, and it's basically kind of a mental checklist that I did outwardly for a long time, like the long today in crude oil when I was, initially looking for a short there, because it looked like a cheap trade. I wasn't going to have to lose a lot, and I was able to get flipped around and catch a good part of that move. It's okay, what's I would start at the longer time frame. Where are we as far as the weekly chart? Are we at a level that's going to be important for other time frame players? The daily chart, and it's a lot to think about before putting on a trade. Sometimes you're going to put the trade on and then finish your thought process, but it's okay, what kind of day type have we been in? What can change in this day type? Has the point of control moved? There's a million different things that can help you, and eventually I think your impulses you don't hear them as loud. Your intuitions have reasons behind them. Okay. Yes, we have not extended the range yet, but point of control has been moving higher all day. Delta might be negative, but we're in the top quarter of the profile. It seems like there's buyers underneath this market, and they're just basically moving the bar up. And sooner or later, these short time framers who are selling it to them are going to have to cover, just the way it happened in crude today. These are all. It's all about, well, Dalton calls it the ruling reason. Even if you're in a counter trend trade, your ruling reason may have been, okay, I think the market in the long term is going lower, but it's oversold. I see evidence in the profiles of the market being oversold. Therefore, I'm going to look for buying opportunities. Okay. There's a myriad of different reasons and things that you're going to be thinking that are going to help you distinguish between impulse and intuition. But it takes time.
Let's take one more question, and then we'll go to the next slide. Raymond wants to know, can you go over the TPO time periods again? Is D, the letter D, is that the second hour, is his question.
Yes. In the S&Ps, the A time bracket would be day 8:30 to 9 o'clock, B 9 o'clock to 9:30, C 9:30 to 10 o'clock, D 10 o'clock to 10:30.
Okay.
And so on and so forth. Okay. Let's take a look at another misconception, I would call this one, not necessarily a mistake. I've had a lot of people tell me that they're nervous about learning. Oops. Where did that one come from? Here we go. Okay, they're nervous about learning profile because they think that they're pretty good with their other analysis, and but still, not to the point where they believe they can be successful for the long term in trading futures. The same information that's in your charts, if you are looking at 30-minute chart, is in the profile. Even if you're not looking at a 30-minute chart, a lot of the same information is in there, and profiles can be set for different time periods. That's a webinar for another day. The profile picture is going to change in real time as new information comes to the market. I can't even count how many people I've worked with and spoken to about profile and helped them learn about profile that have come back to me and said, you know, these value area levels are lining up almost to the tick with some of the fib levels that I'm looking at. You know, how does that happen? Well, the information is very similar, but the way it's viewed is a little bit different. And I like fib levels for longer time frame targets in the daily in the daily realm. I haven't really found that much use for them, but again, so many of them have come back to me and said, you know, I've learned some of the basics of profile for you. I've been watching it. I started doing it by hand. I'm calculating, you know, value areas by hand, and every time I calculate the value area throughout the day, things are lining up closer and closer to some of the levels that I'm looking at, whether they're, you know, pivot levels, whether they're support lines. So I think it can be a very important addition to what you're looking at, especially when you have unrelated studies lining up in that fashion. I've seen a couple of people really learn to increase their success by using that combination. I really feel like the profile is going to point out the good trade ideas long before any chart or study. Because of the features of the profile, there are times when you don't have to wait for chart structure to anticipate getting into a trade. The crude trade today, when I took that short up near the high of the balance area there, I shouldn't have taken that one. That was a mental mistake on my part. I should have been patient and waited to see if that market was going to break out to the upside. Why? Because I had profile, both volume and market profile, show me point of control moving higher. I had made an assumption early in the day that we were going to have overlapping to lower value, which we ended up doing. Here's yesterday's value area, here's today's value area. It's overlapping to lower, but we didn't see any follow through to the downside. As a matter of fact, the pressure seemed to be to the upside. The short here for me was a mental mistake, and as soon as this market started taking out this selling tail up here, I should have well, which I did. I jumped on it and caught a piece of it. But anyway, that intuition should have been already in me, already thought out. I was not prepared for that, and I made a mental mistake. It's a complement to any discretionary strategy to understand the profile, to understand the auction process, and to start gauging activity at key levels. Now, after I just told you that, the next mistake that I see people making is not taking the cheap trades, which was why I took that trade. Oh, okay. Here's what I'm talking about with the same information. This is the 30-minute chart for an entire day in the S&P's recent day. I'm not sure which day. This is the entire profile graphic for that day, and this is the entire volume profile graphic for that day. The profile graphic, actually, this doesn't point out opening range, but each bar, its open and close, is also signified in each bar here. So this is the 830 bar, the high and the low, the open and the close. This is the 9 o'clock bar, the open and the close. Open, close. This is the 930 bar, open, close. The exact same information when you separate the profile is available to you, just like the chart. Just the way the information is organized in time has helped me and many others that I know recognize opportunity earlier, and that is what our goal is. Goal 1, limit risk. Goal 2, recognize that opportunity. Recognize when that opportunity is there.
Hey, John, there's a couple more questions.
Go for it.
Both Bill and I think Sandra was asking a similar question, which was basically, how do you know what these key levels are? How do you gauge participation at those key levels, and how do you identify the key levels?
Okay, great questions. In the day time frame, let's go to the next slide. Oh, you see the information here is very similar. The next slide is the same profile graphic, but everything is moved over to the y-axis. So as this profile develops, you have the initial balance. At this point, the point of control is down here. Okay, value is probably from here to here. As this profile develops, you can see the point of control moves up, value moves up, and you begin to see the extremes where the market has been accepted or rejected. Initial rejection up here, a 3 TPO tail is not necessarily rejection. But one thing that you can notice in this is we had rejection at the lows, very low volume in the lower third of the profile. We spent all our time here, and a lot of that was midday, so of course our volume is going to stack up there. We spent more time. Volume, I can't show it to you, but by looking at this, I'm relatively sure that volume TPO also moved up. So then we have the market late in the day moving up to the highs. So we had the open, we had balance, and then we had a test above balance. The key levels that you're going to look for in the day time frame are always going to be the extremes. Anything that's necessarily above value or below value are your best trade locations. The vast majority of the time. There are times when a point of control, it can be a good target or a good entry. Those are fewer and further between. So as the market moves up here, if we didn't run out of time, what was going to happen to this market? Okay, we had already taken out rejection. We had tested it. We had tested again. Now we've taken out rejection and we've continued higher. Now I'm looking to the volume. Okay, as the volume stacks up here. Now we don't have any real gauges to what the volume was at this time, but we didn't have a lot of time to rack up volume here. I can tell you that this area down here did not draw volume. It makes complete sense that the market would test higher in search of volume, which it was finding. We spent, M is 2:30 to 3 o'clock, N is 3 o'clock to 3:15. In 45 minutes, we had stacked up more volume in this area than we had in an hour and a half here. That would lead me to, that would lead me to believe that this market was probably more likely to break out the upside than of course it was the downside. Of course, we're trading there. Had the market not run out of time, I would have been very cautious, taking a short here and monitoring for continuing activity to the upside. Does that make sense? So your key levels are your areas of rejection and acceptance. Here we had a very balanced day that looked like it was about to move out of balance because it did not attract volume in this direction. It had sat most of the day in value and was now leaving value in search of volume and perhaps on its way to finding it. If it didn't close, this very well may have continued. Now, if you take a look at the key level in crude today, okay, we have We had a big rejection of higher prices here in this D bracket. This is a substantial negative feature of this profile. We did not have that big of a rejection at the lows here. A lot of people, I think, were really looking for this market to break today, and I think some longer time frame traders took advantage of that fact, got them all short, and then ran it up on them. But this was a critical area, okay? So we had run up here in D period. We traded all the way back to the low of value. We rotated through value a couple of times, and we started leaving higher lows. By the end of the day, point of control had started moving up, volume had started moving up, and we had, I'm sure, started to, if we didn't run out of time, we would have started moving value up as well. But what I want you to look at here is, as the market left this balance area, it picked up volume in this area very quickly. Okay, there was a lot of price action. There was a lot of buying coming in here. There was a fight going on, okay? There were people interested in seeing this market moving in this direction, and that just added fuel to the fire. You can see these little volume pockets here, okay? These are little verifiers that price is being accepted at higher levels. You can see little ones here. I mean, we really didn't spend a lot of time in these areas, but these little pockets of volume there are verifiers that, okay, this direction is being accepted by the market. Yesterday's range and value no longer accepted. We're picking up volume as we go higher, more likely to continue that direction. Now, this ran out of time. Since then, it's come off a little bit. Participation, you know, the pit is closed. Here's the 30-minute. You can see on this 30-minute chart, I even have the volume profile. This is the volume profile histogram for today. I can hold this cursor over any price, and it tells me what the volume was at that price in the upper left corner. You can see VPR 2143 traded at 91.35.53. So at any time I can check what the volume is at a given price. And this is the all session. This is why it looks like this. The day session volume point of control is a little higher than that. So
right.
Does that make sense? That, I mean, finding the good trade locations is it's a long story. That's a webinar for another day. Then we can certainly do that.
Right. Here's two more quick questions before we move on. Sandra's asking a follow-up. Do you use any type of order flow to determine the change?
Any tools? Any tools? No. I just try and watch and gauge that on my own. It's something that I've had to do for the last 22 years in trading. You know, starting in the pit, one of the things you're always looking for is order flow. In the pit, we could see Morgan, we could see Goldman, we could see Shycorp, we could see all these companies and what they were doing. We could watch as they came into the market, as they got out of the market. We could see the pit getting longer and shorter. So reading order flow is something that I think anybody can do. It's just something that takes time. Even those with order flow reading tools aren't always making the right decisions.
Okay. And the last.
Not that I don't like the tools. I think some of them are probably very useful, but I just haven't. I don't really feel that I've had the need to use them. I've checked them out.
Okay, last question before we keep going. Deanna is asking, do you always look at the 30-minute profile, or do you ever combine it with a longer time frame?
I do take the daily 30-minute profiles, and I will look at a composite profile of 5 days and occasionally longer, particularly if we have been stuck in a longer time frame range for a long period of time, because I think that when you're stuck in a range balance for a long period of time, I'm talking, you know, probably you know, a couple of weeks or longer, that I find that the breakout from that area of balance is much more likely to occur when I have a balanced profile, when there's no holes in it, when it's a nice bell curve. Then I think the market is like this. If this were a month-long profile, I would say this market was primed for a breakout because it's giving us a good bell curve.
Okay.
Yeah, you know, sometimes, I mean, I don't look at like an hourly profile or a 2 hourly profile. I do, on occasion, keep a 5-minute, I mean, excuse me, a 10-minute profile in more volatile markets, because I want to see point of control and value move a little bit faster, and sometimes that will help me with a decision. Well, that's another webinar. Okay, so I guess we'll continue.
Yeah. Let's keep going. I know you got more slides.
Okay, yeah, just a few, and you know, I'm not in a hurry, but okay, not taking the cheap trades. That's what I did today, and it was a mistake. But you know what it cost me? It cost me 10 ticks. You know what the breakout made me a lot more than that. I find that sometimes when you are trading the extremes, especially in a day that is trading in balance, similar to the profile that we've been looking at in the slides here, trading the extremes is sometimes difficult. It's very easy to limit the risk, but everybody, it seems, not everybody, but it seems the majority of traders love to catch the big breakouts. And who wouldn't? You know, that breakout in crude today, if you were the right way, you could not mess up that trade unless, of course, you only took 5 ticks on it. So the cheap trades are the extreme faders, okay? The cheap trade in crude oil today would have been right down here, okay? E period actually made okay, E period trading down here, C period, E period never made it to the low of B even, okay? If you were there and you said, okay, you know what, this is a cheap trade, I can risk 10 ticks to a new low, and maybe I can buy crude here and just because it looks cheap. Well, it turned out to be one of the best trades you might have ever made. And if you can limit the risk, just by taking these cheap trades, I've ended up with some fantastic trades, even, you know, in a day that doesn't break out the upside. So if you can limit the risk, that's to me, job number one for a trader is limit risk, and the extremes are going to show you that. The cheap trades are at the extremes of balances. They are where change is either going to occur or it's not going to occur. Yes, there are false breakouts. Yes, there are breakouts where you're going to lose money initially on the trade, but if you are monitoring price action and volume as the market moves away from previous balance, you should be able to, again, find a cheap way to get in if it's a false breakout, or if it is a continuation breakout. If it's like it was today in crude, boy, that was a tough one to try and find a cheap way to get in because it just really went. But how do you know which way to trade? It's at those extremes, and you've got to monitor price and volume. You've got to monitor volume, participation. When you get to those levels of rejection, or excess, as they're called, okay? The market doesn't spend a lot of time there, hasn't spent a lot of time there. This is a place where I have to make a decision. Okay, now, how do I know which way to trade? Well, what's the rest of the profile look like? Does it look like the market has other time frame players in it moving the market that direction? What's the short time frame inventory, okay? In crude today, I believe, and there's no way to prove this, but I believe that we had buyers basically moving the bar up all day, longer time frame buyers, and the short time frame ended up very short by the end of the day and having to cover. One of the things I discussed in the strategy lab today was, isn't it strange how crude is at this time, let's see, it's at 11 o'clock, so we're trading up in here, I think. Isn't it strange how crude is kind of holding in the upper third or the upper quarter of the initial balance, and it had negative delta. Delta was negative 1600 or something like that. So you've got more aggressive sellers, but price just keeps ratcheting higher. Okay, this is the delta right up here. This D 1630 is where it ended the day, and that's not that positive a delta for the way this market took off. So it started out pretty negative and ended up positive on the day because all those aggressive sellers needed to turn around and be aggressive buyers. So there are no-go, no-go areas. Those extremes, the areas of rejection, those are your go, no-go areas. And let me give you an example of rejection. This is the gold profile from the day session today. This profile looks like there was probably some long liquidation going on whenever you have a B shape like this. And this is also another interesting situation because if you look at delta, delta's 1178. Okay, that indicates there were more aggressive buyers in this entire profile than there were sellers, and yet we couldn't hold a rally. Were there sellers in this market? Or is this market getting too long? And this was probably long liquidation. So what we're looking for is excess. Okay, we really didn't get that much of an opportunity to trade back up into this excess. Okay, we took a look higher, it failed. Okay, this auction failed. Look at how little volume there is up here. It didn't draw activity. The market returned to the initial balance. As close as we got as being able to sell near this rejection area, it was back here in F period. Now, in F period, the high of value was probably somewhere in that area. Trading the high of value was trading an extreme and gave you probably one of the best opportunities for a trade in gold today. Gold has been very chintzy late in the day. It really doesn't give that much of an opportunity. So finding those good trades is those cheap trades. Sometimes, even if it's just a cheap trade, it turns into something absolutely beautiful, and it's a risk-limiting trade. I'm very quick to take those. Knowing which way to trade is another trick. You've got to watch volume. Number 4, I talk to people all the time that say, you still look at market profile, it's no longer valid. Well, it's a form of analysis, and I believe that no form of analysis works. A market is a market, folks. They all work the same way. The auction process is the same as it always was, and I think that the profile is even more valid and important today than in the open outcry days. I used to be able to see my competitors. I used to be able to see the other time frame players entering into the market and exiting the market. We can't do that now. No form of analysis works. It's in the interpretation, it's in the expertise and the knowledge of the user. And by knowledge, I mean more self-knowledge than I do market knowledge. Market knowledge is great. Knowledge of the profile, great. The auction process hasn't changed. I used to hide the fact that I was using market profile to trade because I didn't want other people to know about it. I thought it was a tool that if more people knew about it, it was going to hurt its usefulness. It's not true, because most people, I don't think, ever really get to the point where they are competent enough to use it correctly, and that's a matter of commitment and time.
They want to use it as a sorry, John. They want to use it as a signal generator, right? That's what everybody wants.
Absolutely.
Signals. Yep.
Absolutely. The profile doesn't work. Well, what do you mean it doesn't work? It's not going to provide you signals. So
it provides you context.
I hear that all the time, that the profile, absolutely. the profile is not that good, or everyone would be using it. I say, okay, great, fine, you're right. It's only as good as the person interpreting it, and anybody can do it. It is completely up to you, and it doesn't take years of school. That's the one thing that I love about this business, is you don't have to have a PhD, and you can be an expert at what you're doing, or you can at least be very good. I don't know many experts, and I am certainly not one. There's a lot that I still need to learn, that I still want to learn, and I would not call myself an expert by any means, but I am a very competent user of market profile and volume profile, and I didn't have to go to 2 years of school to find out. I didn't have to have student loans. I didn't have to get a doctorate. I didn't have to get a degree. And I have the opportunity now to enjoy this continuous learning process and take others along the ride with me, which is something that I really enjoy. I need to mute everybody for just a second. Hang on. There's no way I thought that this was all going to take this long, so I do apologize. I do not think everybody needs to be sitting here listening to me ramble about this. Well, let's get into questions and see if we can really help set anybody on the right way.
Okay, so David asks, if the value area of the market profile TPO is lower than the value area of the volume profile, does that mean anything?
Yeah, it certainly does mean something. Let's see if we can find a good example here. The value areas in certain platforms seem to have an algorithm with them that doesn't really represent 70%. I'm see if I can find a good example here. All right, here, look at the S&Ps today. All right, here's the S&P profile. Oh, the initial balance, the first drive higher, an area of balance, and the close. The high of volume value they have right up to the high of the day here. Okay, the TPO profile they have lagging here. Okay, this is an example of I believe a market that found that really needed to move away from where it was, and found great volume up at the highs. Okay, we didn't spend a lot of time down in these areas, but the volume point of control is right up near the high here. Okay, so when this market started moving higher, volume moved the value area from volume profile a lot quicker than time moved the value area from TPO profile. Okay, if this market explored up in this area but didn't draw this much volume, you'd see the volume profile probably a lot closer to the high of the TPO profile. This market to me drew great volume and is probably going to continue in this direction in coming days, because it drew the volume value area much faster than the TPO value area. Sometimes time will draw the TPO value area higher than the volume value area when volume doesn't show up, and that's to me a sign saying, okay, this excursion is failing, and it's more likely to return to value and points lower than it is to continue. I'm saying that the day session kind of, here's the 30-minute. Okay, the day session closed. We didn't break. Okay, we're still hanging right up here in this area. If this didn't draw the volume that it did, I would think that we would have seen a lot, much more of a fall off from the highs from the day session here than we have. So to me, that indicates that there is a lot more volume above to find than returning to previous balance and looking for more volume there. The volume's higher is what that's saying.
All right, we got about 10 questions or so at this point. Tony's asking, so if he understands correctly, you're basically saying that profile is showing him that he should trade based on value as opposed to trading based on price.
That is true. You've got to look at things in context. The value area is a longer time frame than a lot of than some of the moves you're going to be looking at. If we're trading value, we're trading a longer context, I would say. If you're trading price, and this is contrary to what a lot of people would say. I've been listening to and reading Dalton forever, and I get what he's saying about trading value instead of price. What I'm trading is the extremes of value and the changes of value. I believe that the S&P's put up a big change in value today. Okay, we got hit a couple of days last week, and I think that we have proven in volume that we're headed the other direction. So yes, over time, if you see value moving in a particular direction and volume increasing in that direction, you want to continue to trade in that direction. When value starts to even out or volume starts to die out in that direction, an impending change is probably coming. So if you, let's say, well, it's difficult for me to find an example of what I'm trying to say here, but value moves over days too. Okay, so if you see value, it may be a good example here in maybe this will work. Hang on one second. You see value moving in one direction over time. Okay, here we have kind of a blow off top here. Okay, now we have value starting to move lower. Okay, yeah, this is not the best example. We've really just started to kind of balance here. Hang on a second, there may be something in the S&Ps. Okay, we're getting back to the beginning of the December front month contract here, but okay, we have value over time in large part moving higher. Okay, now yeah, see, this is hard because this is the old contract. I don't have the real volume. But, well, let's take a look. We have value moving in basically this one direction, as S&Ps have been doing basically all year long. This is a little bit shorter context for you. Now you see some potential weakness. Okay, we have the market seems to be running out of energy to the upside. It's not really being rejected, but like running up a hill, it seems to be running a little bit tired at this point. And then you see value start to trade lower. You have lower, overlapping lower, inside, lower value, overlapping lower, inside, overlapping lower, and now you've got overlapping lower here, but you've got a balancing day right here. Yeah, this is probably indicating that some kind of change is imminent. It's either going to balance here for a little while, or it's either going to balance here, continue lower, or continue higher. Easy to say, right? Opening here, the big strong day to the upside, just a couple of days after the rollover. Okay, now we've got value moving higher. Okay, we've left balance, not even overlapping higher. Okay, now we're overlapping higher. Now we're flat out higher. We're overlapping higher. You get the opportunity here to see. Okay, we got overlapping higher. We've got flat out higher. If this isn't accelerating, then it's probably changing. It doesn't accelerate. We're overlapping higher by the end of the day. Okay. And then, you know, we get smacked. Some of this is news-driven and really kind of not all that technical, but trying to find an example on the fly here is a little bit more difficult than I thought it would be for that.
Sure.
So
okay.
yes, you are trading value, but you got to keep value in context. Value is something that you're going to have to look at over time, more than probably the day time frame. In a longer time frame, you want to watch how value is moving and how volume is increasing or decreasing. And with the equities, it's probably not that great an example because the S&Ps, the futures anyway, don't seem to need a lot of volume to keep moving higher.
Okay, there's still a lot of questions. Deanna is asking, after the price has gone above value, would you consider a retest of the value high to be a good trade location for further upside?
That is a great question, and yes, I would. If I am seeing an increase in activity and volume, but I'm not seeing a really fast rejection, then I have seen on multiple occasions and had some success trading with the high of value as support from that level. It's a great question.
Okay, Robert is asking...
Now...
Sorry. Go ahead.
Go ahead. No, I'm sorry. Go ahead.
Okay. Robert's asking, how do you... All right, go ahead, John.
You have to be careful because that return to value sometimes is marking a failed breakout, and you really have to watch price activity and volume above that level. If it seems to start stacking up and increase, and you know a short little decrease brings market back down to the value area, then you might be looking at a continuation of the upside. It has to bring in volume, and it's a touch. It really is.
Okay. Robert asks, how do you know it's an extreme until well after price has moved away from the extreme? It seems that you could see the same thing on a bar chart, but aren't we late by the time we identify the level as an extreme and as retail buyers or sellers opposing the wholesale?
A lot of times you're going to be, unless you are a very, very good innovator. I never really try and encourage people to pick tops or bottoms. You've got to look at, again, context. What is the day type you're expecting? What is the inventory of the short time frame traders? What's the inventory for the longer time frame traders? Are you in an important area? Sometimes it is extremely easy to pick an extreme early in the day. Case in point, trend days. Let's take a look. This is crude oil. Here's a day where the opening range was at one extreme of the initial balance. Okay, so it was all this trade occurred before the market returned above the opening range and continued higher. This is a pretty strong signal right there in itself. Early in the day, though, the opening range was the high of the day. If I see confidence in the market in a particular direction, as soon as we leave the opening range, I trade in that direction. This was a relatively not the most confident opening that I've seen. As a matter of fact, I would call it really kind of a lack of confidence. When a market does not have confidence, one of the first things it will probably do, if it doesn't draw players into it before this happens, is trade to the previous day's point of control. So this trade, we had a target only of the previous day's point of control, which was 90.92. Okay, that's about 50 ticks. Okay, great trade. We don't know this is going to be the extreme. We have no idea. Okay, so as this day goes on, now we're looking at, this is the low, this is the high, B period. Okay, put in that low and returns to the A period. Now we're looking at value somewhere around here. All right, we got our target. We got our 90.92. This is kind of runoff here. Okay, did I buy this? Hell no. I was short only until this fell, until the opening range gave way. Okay. So did I buy this extreme? No, I did not. I did not. But we ended up balancing in this area. Okay. We never really returned to this area of rejection. So this was a very difficult day to pick an extreme, because this was basically, by the end of D bracket, almost the middle of the range, and I'm not touching that. Okay, so I was pretty much done with this day. But look at how many days start out that way. Okay, high of the day, high of the day. Now it's going to make a liar out of me. Almost the high of the day, low of the day, and a reversal like that one day. Low of the day, low of the day. No. Low of the day. Think about that. It seems like maybe 40% of the days that we've looked at have an opening, have an initial balance at the extreme. It's one way to find an extreme. Here is another day, maybe not the best example, but a market that leaves its initial balance. This is called a neutral variation seller composite day. All right. E period never makes a new low below D. If you looked at this like an opportunity to take a cheap trade here in the single ticks of D bracket, which is risky, but you're only risking this much. You're only risking a few ticks. If it makes a new low by a couple, you're out. It ended up putting in a double bottom and returning to rotational trade, I call it. Okay, this was a tough trade to take. That's why the cheap trades are not always easy, because they're testing you. They're testing into areas that were previously rejection. Everybody wants to catch this breakout. Oh, look, crude's making new lows, or it's about to. Sell them, sell them, sell them. If it doesn't bring in the volume, you see it taper off here, then it's going to return to at least the mean, the point of control, maybe points higher. So it's not always easy to find a cheap trade. It's not always easy to find the extreme or to trade the extreme. But when it is, I'm suggesting you seriously consider taking that cheap trade. God, there was one a week or so ago. I couldn't believe how good it was, and I can't seem to pull it up right now. But
here's a question from Samuel. He says, John, you mentioned the best locations are at the extremes of value, which work great for reversal trades. But what about key levels for a pullback trade during a trend when we're usually above the value area?
Okay, another great question. That's your volume profile. Very important coming into play. Let's use today's crude as an example, and this is really extreme, but it kind of gives you an idea of what you're looking for, and because you've got to be quick for a pullback. All right, crude breaks out the upside. Okay, J period comes up here. K never returns to value. One of the questions was, would you use the high of value as a reference point? Well, this may have been one of those points where J period broke out, came back, traded the high of value, and we went. So how do you find a pullback? What's an extreme area in a pullback? Okay, this is something that I use all the time, and it's helped me. I've always been a terrible trend trader, but this has definitely improved my performance when it comes to being a trend trader. Here, hold on, I gotta get you on screen here. I apologize. I'm all of a sudden I'm in strategy lab all of a sudden. Okay, so this is an example of a possible good pullback to the high of value in order to have a place to come back to continuation. K period never made it back there. I don't know if J did. But once this breakout started happening, okay, you've got rejection in volume here. Now you've got, I call these volume shoulders. I don't know if anybody has a better word for them, but when you get these volume bubbles like this, okay, K period probably came up here and it waffled for a little while, okay? It did this, it maybe traded back and forth in this area for a little while. Hanging bids at the low here can be a great cheap way to get into this, okay? It's kind of what I did here. I believe is about where I got into that today, right over 92 bucks. Here is another opportunity, volume shoulder. You got, didn't really rack up any volume, probably didn't return to those prices once it got up in this area. That's what you want. Okay, here might have been another little opportunity to do that. You've got more risk in this, but as strong as this was, it may have been worth it. And that's another thing you've got to get used to when you're dealing with getting into already trending markets, is you're probably going to be required, you're probably going to need to give yourself a little bit more risk. But when a market is in imbalance, your opportunity is also greater as well. Getting into a trending market, I think you do have to give it more room. But again, your opportunity, your profit opportunity is a lot larger as well.
Okay.
So that's what I look for, is these little volume shoulders if the market is already trending.
Right. Okay, I'm trying to pick just a few more questions here since we're running up at the hour and a half area. Looks like Fred is asking, what's the difference between taking a cheap trade and calling a top or bottom, which is by many considered a very expensive or bad habit?
Because the top or bottom is already in, okay? There is already evidence of rejection at that level, Fred. Well, let me see. Cheap trades, cheap trades, cheap trades. Let's go back to this day. Okay, this was the 19th. D period traded down here. E period traded back there. This low has already been established. Okay, a cheap trade would be, okay, all right, well, it looks like we're taking another stab at the low here. It doesn't look like much is going on. Maybe volume dies off, trades down to E period, never even puts in a poor low. So if the market gets back down, and when the market gets back down here, if you were thinking, okay, this is a cheap long, it's worth 8 ticks to find out if it's going to hold. If it does hold, what's it worth? Well, by the end of F period, we're trading 91.69. Down here we're trading, okay, it's worth 50 ticks if you hold it to the high of F period. So I can risk 8, 10 ticks, and even if I hold it to then point of control was probably right here. Even if I hold it to point of control, I'm better than 1-to-1 my risk reward. Okay, there's a cheap trade. Look at today. Is this today? Yes, this is today. E period. E period trades within 1, 2, 3, 4, 5, 6, 7, 8 ticks of the low. E period comes down here. Low of value was probably right down here as well. Here's a cheap trade. E period, well, you know, the low is already in. We don't know it's going to remain the low, of course. It's much easier with hindsight. But that's why these are great trades sometimes, because if you did take this trade and your stop was 2 ticks below, you could have gone up to the counter at Starbucks, got yourself 4 coffees, and told yourself, you know what, this looks like a really good trade. If I don't get stopped out, I'm getting out on the close. Maybe you would, maybe you wouldn't have. But that's a hell of a trade just because it was cheap.
Here's a couple more questions,
now,
John.
You got a market that is...
Sorry. Sorry about that. Go ahead.
Oh, okay. I mean, you got a market like this, there's no way I'm picking a top in this. I'm waiting. Now I'm out. I'm done. I have to wait now. I am waiting for structure before my next move in this market. If I'm long it, great. You know, I'm going to hold on to it for whatever I think it's worth, and then I'm done. But other than that, there's no way I'm picking a top in this. So you can look at it in context, Fred. You've got context on the lows here. You don't on the way up.
Let's see. Alan is asking, why is it that profiling does not determine direction? Doesn't taking cheap trades equate to expecting the market to move back to the highest auction levels, such as the volume point of control?
Sure. Yeah. Yeah. What it does, we're not really determining direction by taking this cheap trade. We're thinking, okay, if the downward auction is over, we have great profit potential. You know, if we get back to volume point of control, we get back to point of control. Maybe we even test the high of value while this trade is on. Okay? So we've already looked down here twice. B period and C period didn't bring enough volume to continue in that direction yet. But we've already got two half-hour periods trading down in this area showing a little bit of rejection that the market's really not interested in trading down there because it didn't bring volume, it didn't continue to begin with. Now we're within 8 or 10 ticks of the low of the day, and you look what happens.
A few more questions. Deanna asking, hey, John, you mentioned a bell curve and also a B, as in boy-shaped profile. Are there any other shapes of market profile that we should be aware of, and could you explain what they signify?
Sure. Look at gold today. That was our B shape. Okay, this is indicative of a long liquidation day. Okay, you have sellers in the market, but they're usually not that aggressive where they're going to continue pushing the market to lower and lower levels. All they're trying to do is usually rectify an inventory. Maybe it's a longer time frame that's getting out of some longs because they're getting into something else. So that what they do is they keep pressure on just by hanging offers and letting the short time frame feed on those offers throughout the day. A lot of times these people will have somebody else execute their orders. They still don't want the execution risk, so they'll call a guy on the floor and they'll say, listen, we got 2,000 gold to sell. We want you to take all day to do it. So basically, the guy at the desk will say, okay, well, I need to sell so many, every half an hour, so I'm going to hang an offer here, and whatever I don't have done by the end of this half hour, I'll hit with the market. Then I'll hang another offer lower. And whatever I don't get done by that half hour, I'll hit at the market. And then I'll hang another offer lower. And by the time he gets near the end of that 200 or that 2,000 contracts that he's got to sell, he's going to try and make the last couple hundred look really bad, so the first 1,800 look great. So he can call his customer and say, yeah, we got them done real nice for you.
Okay.
All right. Now, the opposite is true of a P shape. If you see a P shape profile, which you'll see quite often in the equities. Hang on, I'm trying to move this. Okay. You'll see those quite often in the equities. Why? Because they are usually, they're really good at, see, this is the old contract, and we're going to get some dicey. Here's a P shape. The equities have always been really good at getting short time frame short and then squeezing them. So you got day after day after day in some cases here. Here's a P shape. These are little dicey profiles because it's before Dees was the front month. You get short time frame traders short, and then they end up having to cover, and it just perpetuates the market moving higher. It's been doing it since 1982 when the S&P pit opened. The floor short time frame traders, local traders, love to be short. They've been paid handsomely on 4 or 5 days for it in the last 30 years, like October '87. The shorts really ate up, and they remember that, and they love being short. The money comes faster short. When the market goes down, it usually goes down faster than it goes up. But here, P shape after P shape. These are short covering days where you have people adjusting short positions, adjusting their inventory from short positions, and you end up with that P shape because they're not strong enough buyers to push the market through the highs too much. Okay, yeah, they will, but they're not going to run it up on themselves. Okay, the P shape indicates probably short covering activity.
Okay, I'm going to combine these next questions, and we'll make these the last questions since we're at an hour and a half. Andrew's asking regarding the CTS T4 platform. Andrew, that's what he uses. Could you go over today's profile in the S&Ps and highlight some key points of opportunity as they were happening today? And John basically wanted the same thing.
Okay, great. This was the play of the day in Strategy Lab this morning. We wouldn't really call it that, but it ended up being. God bless it. Okay, we were looking at. We got hit pretty hard. Was this? Today's Wednesday, Monday, Tuesday. Okay. We were getting down to some levels that we haven't seen for a little while here. This day's low in particular was of interest to me because it has been quite some time since we have tested below that and seen any acceptance. Okay, there's point A. Point B, this is our overnight profile in the S&Ps. I don't really pay too much attention to anything but the high and the low of the overnight trade. The overnight low, 69.5, exactly the low from that day. I forget which day it was. Now, we did trade below this after the close yesterday, right? So we're looking at a selling spike down to 74.50. Okay. Now, I told Strategy Lab because this was at 7:15 in the morning. I said if the S&Ps don't open below 74.50, they are rejecting this spike okay, even if they trade down into it, anything above 69.5, I'm only trading from the long side. We traded down to 70.50, 4 ticks off the overnight low, and we had a very, very nice, strong move to the upside. So the opening range did not have a lot of confidence, but in relation to the selling spike at the end of the day yesterday, it was signaling rejection of this level. No matter what happened in the overnight, I'm only interested in where the day session opens compared to the day session. Yes, I'm watching the range from the night before. This indicated this spike is being rejected in price because it opened there. I don't care if it trades down to it. Anything above 69.5, I'm only trading from the long side. So A period, the first half-hour period, doesn't offer a lot of opportunities. I think it traded higher first, then it traded lower and started getting down near that 69.5. Okay, it never got to that 69.5, which is another positive in my book. We didn't open in the previous day's spike at the end of the day, and we did not trade to the overnight low. That overnight low, this level from, what day was that? The 15th. Okay, we got to go pretty far back before we get back below that. So that to me is an important level. We don't trade to the overnight low. We trade back above the opening range. We rotate up to near the high in C. We don't trade below the low of A in C period. 0.3. Now, this area is cheap. This is a cheap trade. If we can get there, I'm going to buy 1,000. No, we didn't get there. And I didn't buy 1,000, trust me. And then leaving the initial balance, trading pretty much straight through yesterday's point of control. This is TPO point of control. Volume point of control still up here, but TPO point of control, we pretty much traded straight through it, and we started to build a little volume shoulder right here in these single ticks. So the market waffled a little bit here before it continued. This was a chance to get into this breakout, and if you were to get into this breakout and it were to return to the previous range, do you take a look at what volume occurred? And if you don't see an increase in volume and activity up here and it returns to value, which value was probably somewhere around high of value without all this, was probably somewhere around 78.25 at this time. Returns to value because you didn't see any volume up here, well, then maybe it's time to get out and take another look. If it breaks out again, maybe you'll have another opportunity to try and get in on it. Okay, so there's 3 or 4 little indicators right there that that this market is interested in moving higher. Okay, stop short of yesterday's high of value for the day session. This was a little bit of a marker for me. I would have preferred it traded to it or just tick over it, but the fact that we never took out the single ticks here, okay, we had E, F, and G attempt to take out the single ticks in D. Okay, this is an area of excess or rejection now. Okay, so the volume was enough to bring us up to a new area of balance, and that area of balance keeps extending to the upside. So as long as we don't take these out, these single ticks, I'm still trading from the long side. So now I'm getting good reference. If I miss this, I'm seeing balance here, and I'm getting good reference for what a cheap trade is up here. Okay? So in F period or G period, I get an opportunity to try and buy it at the low of this little volume shoulder, and if we get too far into these single ticks, maybe I need to be out. But we didn't get into those single ticks, and we continue to rotate higher. If you look at this split, I believe your technicians would call this a bull flag. Okay, and we ended up drawing probably the biggest volume of the day, right up at the high 8 ticks, 10 ticks up here. Okay, this is our volume point of control. After all this whole day, in the last 45 minutes, the last hour, this was our point of control. We drew volume up there today.
Okay.
That helps.
All right, John. So since we're at an hour and a half, I'm going to stop the questions, but I just want you to give out your contact information so anybody that has any other questions that they did not get answered, they can get in touch with you.
Of course. For Big Mike's Elite members, you get 20% off your first combine at TopstepTrader if that's something that you're interested in testing yourself with or getting involved with. You can also contact us at that number, 888-407-1611, or at info@topsteptrader.com for more information about TopstepTrader or about the Market Profile Strategy Lab and to redeem this offer. So let us hear from you. Hopefully you found something useful. Big Mike, thank you very, very much for hosting today. Sorry it ran so long. Everybody that attended, thank you. I can't thank you enough for your time, and take what you can use from this. I'm sure that there's something, and hopefully it'll help improve your performance and your probability of success.
All right. Thank you very much, John. I really appreciate your time. And I'll post the recording of this webinar on BMT sometime tomorrow. You can also find it on our YouTube channel if you guys want to watch it again. Thanks, John. I'll see you around.
Thanks, Mike.
Thanks, guys.
Take care. Take care, everybody.
All right. Bye.